Good evening. This is Ken Long with a review of the weekend trading plan for October 15th, 2017. Market is in bullish quiet conditions. On an annual basis, using NDX 260, it remains overbought at 99 out of 100. On a 10-day basis, using NDX 10, it's also overbought at 92 out of 100. Price with respect to the 200-day moving average is green bullish, so over 4% above the 200-day. Slope of the 50 has improved to 0.30%, white neutral. ADX is now a strongly upward trending 29.4. The risk index is the 30-period moving average of the VIX divided by the 10-period. That number is 1.049 and is in risk on because the boundary between risk on and risk off is 1.0. We take that score of 1.049 and compare it to the last 5,000 trading days and compute the risk Z, which is 0.45 standard deviations above the long-term average. You see here a 90-day time series histogram of that indicator. It's gone from a minus 2 sigma to plus 1.5, and we're still above the zero line. This declining score here, however, suggests we are at increasing risk of sharp volatility events after a long-term exceptional run of low volatility. Blended monthly rebalancing, you can see the candidates that we're holding for October in the three different portfolios and the current leaders based on ETF populations here as of the closing prices on Friday. ETF 2, the theoretical world market exposure is still at 100%. These are the leading candidates from top to bottom in the ETF 13 and 32 portfolios. You see they're predominantly on buy signals based on price relative to the 4-month moving average. Only consumer staples, XLP, and agriculture is suffering right now. The sector spiders are a deeper drill into a set of more narrowly defined business sectors to give you an idea where the strengths and the weaknesses are in the market. ETF Max is the same lens, but now looking at over 800 ETFs of various sectors around the world. Nickel is of interest, and you can see some basic materials along with Brazil dominating in some international markets as well. In the market health check, you see this extraordinarily long run with low volatility over the last 30 days. These vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal blue line was my previous price target. We've broken through to all-time new highs. The horizontal red lines are support levels, which were once resistance levels, and which would act as price targets on the way down if this exceptional run would collapse. We have the dragon sitting right on the edge of the river. The slope of the 10 and the 30 period regression lines are both solidly up. You can see the moving slope value of the 30 is this sine wave looking indicator. Right now it's up at 0.34. It's almost but not quite exceptionally steep. It would have to be above 0.40 before that became truly remarkable. But this has been a pretty good 30-day run so far. Quietly grinding northward move. We've been overbought for a while now, last 12 days, and it can stay that way for quite a while. The percent price oscillator using the 10, 30, and 5. See the jaws had been open to the upside on two legs up. When those jaws when it's above the zero line and the jaws open, that becomes an indication for adding a position or re-entering if you were out. And you can see where those two, really the last three signals, both occurred. So that's a very nice timing indicator for us for swing trades and for describing market conditions. ETF 2 regional report, all 10 of the indexes are on buy signals, so we're in 100% and 0% in the asset allocation strategy. The global's strength at 63 EFA It's still better than the U.S. at 58, so it's the globals are outperforming the U.S. Inside the U.S., it's technology at 76, then the large caps, mid caps, then small caps. The two strongest sectors are emerging markets and Latin America. Two weakest are Asia less Japan and U.S. mid caps. See the sector spiders, energy still lagging a little bit along with staples and utilities. Strength has been in the technology and healthcare areas. World market health check. The U.S. is a mixed bag above and below the database average. Europe is still strong. Emerging markets, Latin America above average. China and South Korea doing exceptionally well. Only Australia and Indonesia and Mexico lagging. ETF top 30, using that lens now to take a look at the larger database. The ones that are green in both strength and consistency are the long-term leaders. Those that are green under strength and white in consistency are ones that have just recently moved towards the top, and so there may be some more room for them to go up. And so that's looking at biotech, China, and emerging markets as emerging strength. The ones that are white and then green are ones that may be giving up a little bit of their former outperformance. Looking now to the daily report, we have a handful of channeling and overreactions, some 5DDs, and a couple auto framers of note, but this has really been a grinding upward move. See, just a handful test out better than 2-to-1 on the auto framer in the Dow 30, and again a handful of channeling and overreactions. A number testing out well on the RSI2 as an early alert for turnarounds. See the real powerful performance down here. Microsoft, Coke, McDonald's, and Walmart leading the way. In the ETF 30s, again, only Mexico lagging, a 5DD in the VIX. The usual suspects are continuing to win. Look at this performance in XIV. When you have these kinds of quiet grinding bulls, XIV can turn in some amazing numbers. 2% gain on Friday, 8% gain over the last 10 days, 22% in the last month, 24% in the last quarter, 50% in the last 6 months, and 185% in the last year. So pay attention to the volatility indexes, not only as ways of describing the markets, but taking advantage of those kinds of moves inside the volatility instrument. Daily pinch and stretch report. The most positive one-day Z stretches. You read this as Walmart being 2 standard deviations above its 30-day moving average, so it's up by the edge of Z2 at the edge of the floodplain, 7% above its 30-period moving average. So the ones in the green are 1 or more standard deviations above the middle of the river. The negative Z stretches that are highlighted in red here are the ones that are more than 1 standard deviation below, so they're out of the river to the downside. So that's price with respect to the middle of the river. And then we look at the width of the river itself. These where the river is wide, like Intel, are ones in which they've had a very strong 30-day move, which has caused the river to widen. The most compressed pinch boxes, which is the width of the river, these are the ones where the 30-period standard deviation is very small, more than 1 standard deviation below average. So this has been an exceptionally compressed move here in Latin America and metals and mining Brazil. So we'll be looking for those as potential breakouts once we get more directional type moves. The auto framer measures some one-day reward to risk ratios better than 2-to-1 if you just buy the mechanical high above yesterday's high and aim for a return to the 10-day high. You get these kinds of reward to risks. The regression line fractal framework is looking at the difference between short-term trading price measured by the RL10 and the long-term investors fair value measured by the RL270, and it expresses that difference in terms of ATR numbers. So Disney is more than 8 ATRs below its long-term fair value, so still some room to go in Disney. The ones in the bottom shelf in the red are the ones that may be overheated. These are the relative strength leaders. These are the ones that are the most numbers of ATRs above their RL270 as measured by ATR, multiples of ATR. The daily squeezes are ones that are postured for one-day potential pops based on the size of their range stat, which is the maximum reasonable intraday move, divided by the size of the previous day's range. So if you get a move above or below the high, move above the high or below the low, and you trade in that direction, if you get a range stat move, then this is the reward to risk ratio that you get for these one-day pops. So this is a combination of relatively larger historical volatility and then a compressed daily move on the previous day. That's what gets you into this kind of compressed spring in either direction for a one-day pop. And that's everything that I want to cover from this weekend. This is Ken Long of Tortoise Capital. Keep your risk measured and powder dry. I'll be posting some trade frames for our subscribers in the chat room, and along with some discussions about our newest interpretation pattern, the MACD, that we are now using successfully in conjunction with our RLCO framework. It helps clarify our insights a little better, and you can expect a home study course coming on that in the next month or so. Take good care, keep your risk measured and your powder dry.